Hello, welcome to the CDH's cross-border family channel. My name is Ko Fujimoto. This is the first English video. I pushed the envelope a little bit to expand my coverage or the videos from not only Japanese, but I decided to challenge the English, producing English videos. Okay, so today I am going to talk about the US exit tax, the basics. I'm going to talk about the US exit tax in two separate videos, including this one. So let's get to it right away. The concept in this slide, I'm going to talk about the concept of exit tax. Most of the viewers of this video, I believe, you are green card holders. So if you're green card holders, at one point of time you were US non-resident, right? And then you are lucky enough to obtain a green card and you become a US resident for the tax purposes. Now, if you are a green card holder, you are a US resident no matter where you are. And this is a topic that I'm going to talk about in a different video. But anyway, for whatever reason, you decide to give up, abandon your green card. Then you become again a US non-resident. While you are US resident, you earn salary, you buy something, you sold something, and but there are certain items the US government has not taxed you. They are unrealized capital gain. You bought something you haven't sold. It appreciated, stocks, real estate, this type of thing, or precious metals. They are unrealized capital gain. The government has not taxed you because you haven't sold it. Second one is government protect you and the money that you save for your retirement. It's called qualified pension plan, qualified plan. Good example is 401k, right? Unless you start receiving a distribution, the money gets never taxed. So it's protected, it grows faster theoretically. So that's a deferred compensation. And the other example of deferred compensation could be restricted stock units or defined benefit plan. And you also may have account like IRA. You rolled over your 401k account balance to individual retirement account. Under the exit tax system, there is a other way of calling this other tax deferred items. It's called specified tax account. Okay, so the concept is really the government is thinking that, okay, before you go out, before you abandon your status of US resident, permanent US resident, we may want to tax some of the money you earned, but we haven't taxed you. This is, I think, the concept of the US exit tax. So who will be subject to the US exit tax? Not everyone. There are two-step approach here. One is long-term resident, LTR, long-term resident, because you have been a green card holder for long time. What's a long time? The rule is 8 years. 8 out of 15 and more, then you are LTR. Remember, if you were a green card holder for even one day in a year, it counts as a 1 year. So remember that. Now, if you are not LTR, forget about watching this video because you're not subject to exit tax. Okay? And then there are three conditions that you become so-called, another term, covered expatriates. One more time, covered expatriates. I'm going to talk about these three conditions in, I think, next slide. So wait until I get to the next slide. Then how to tax is three ways or three items, right? Capital gain that you haven't sold, deferred compensation, and I explained specified tax account such as IRA. Roth IRA is also specified tax account, and health saving account or Section 529, also a specified tax account. Okay, let's get into, because you are concerned now, okay, I can be a covered expatriate. Tell me what are those three conditions. One is the most famous condition, it's called net worth. Net worth test. Net worth test. Maybe I'm not pronouncing TH sound correctly. English is my second, foreign language. So bear with my accent. So by individual, the day before you give up your green card, if your net worth worldwide exceed $2 million, then you become automatically a covered expatriate. Okay? Same thing applies to your spouse too. Okay. Federal income tax compliance 5-year. You must be able to declare that in the last year's tax form specifically Form 8854, you have been in compliance with a federal income tax for 5 years, including foreign bank account reporting, including gifts or inheritance from non-resident, or overall, income reporting such as rental income, overseas, and interest income in overseas, and dividend income, and so forth. So, if you fail to declare, then you become a covered expatriate. Last one is, I haven't seen too many of the individual meet this criteria. It's a 5-year average of federal income tax over a certain amount. Now, you may be wondering which 5 year. Okay, the year before you give up your green card, that's the last of the 5 years. So if I give up my green card 2022, 2021, and 5 years, 21, 20, 19, 18, 17. Right? So those are the 5 years. Okay. If you meet at least one of these three criteria, then you become a covered expatriate. And I think I'm going to explain how the government will tax you if you become a covered expatriate. Okay, thank you very much, and this is the disclaimer of our video. And our cross-border family practice at CDH is explained in here, and looking for new team members. And we have 2 years we have published income tax book for, in this case it's written in Japanese, but cross-border individual income tax handbook. So thank you very much for watching, and bear with my not perfect English. I appreciate it, and see you soon. Thank you.